Hello friends, welcome again. This is Skadvisory Private Limited. This is episode 26, continuation on the ultimate beginner's guide on option trading. This is the last episode. However, to trade price volatility, the option trader needs to be aware of a few more advanced ideas regarding the options market. The trader needs to understand about option pricing, models, implied volatility and what's called option Greeks. Let's first discuss a little bit what is an option pricing model is and how it is used. An option pricing model is nothing more than a mathematical formula that returns the pair price of an option. In other words, it's a mathematical formula that incorporates all the variables that affect the price of an option and organize them in the case of European options. Most famous option pricing model is called the Black-Scholes model, which rendered a Nobel Prize in 1997 for its developers. The Black-Scholes model takes variables like volatility, underlying price, strike price, time until expiration, and the risk-free interest rate to return the fair price of a European stock option. The idea that a mathematical formula will return the fair price of an option seems interesting because we can use the formula to know if the option is overvalued or undervalued, but that's not what happens in reality. The actual price of an option is determined by the forces of supply and demand in the market. So the Black-Scholes formula is actually used to find the implied volatility of an option in the option Greeks based on the option prices given by the natural supply and demand mechanism of the market. The implied volatility in the option Greeks are what institutional option traders use to trade price volatility instead of price direction. The implied volatility is extracted out of the Black-Scholes model. The option Greeks are the partial derivatives of the Black-Scholes model, and each of the Greeks show a different type of risk associated. With an option position, this is just a beginner's guide, so I am not going to go into detail about these ideas. I am just sparking your curiosity for the moment. Trading volatility is more interesting than trading price direction because of something called antifragility, which is an idea proposed by Nicholas Nassim Taleb. When you think about something fragile, you think of something that is very valuable to chokers. For example, a wooden house in the middle of a hurricane is very fragile. When you think about the opposite of a fragility, you think about robustness. For example, a bunker in the middle of a hurricane is robust because it can survive the hurricane. However, robustness is not the opposite of fragility. Robustness dwells in the middle of the anti-fragility spectrum. The opposite of fragility is anti-fragility, which is when something thrives with chokers, something robust only survives chokers. Volatility traders are anti-fragile because they make money when there is chaos. Threshold trade price reaction on the other hand are at best robust. For the most part they are fragile, because when there is too much volatility they are more susceptible to lose money. Volatility traders on the other hand are benefited when the chokers hits the market. It's much easier to rely on chores than it's to rely on the absence of chores. That's why volatility traders have an edge over directional traders. That's why institutional traders like bank traders negotiate volatility through the derivatives market. Learning institutional trading has several advantages. Like I said previously, one of the major advantages is the derivatives in the way the institutional traders operate are anti-fragile, meaning that you can profit when the chaos hits the market. If you take a look at the news on a daily basis, you will quickly realize that making money out of chaos is an indirectly interesting idea because the market is hardly ever free from chaos. There is always some serious political or economic news shocking the market. The other advantage is that the institutional trader is actually easier to apply it in certain price actions. Methodologies, for example, because they are almost 100% mechanical, they deal with price volatility, which is much easier to deal with than the price direction. There is a bit of a paradox in here because trading methodology that is easy to learn tends to be difficult to apply, and a methodology that is more difficult to learn tends to be easier to apply. That's the case with institutional trading. It's a little bit more difficult to learn due to the necessity of learning certain mathematical concepts. But in terms of application, it's much easier than a subjective price action. Analyzes with quite a bit of uncertainty. A third advantage is that institutional trading is actually backed up by hard science. Many of the strategies involving stock options in the institutional paradigm involve several Nobel Prizes winning ideas, which is the highest award in the science. So these strategies are the best that science has to say about how to make money in the market. Another very interesting advantage is that by training volatility, you can make money regardless of price direction, which is a huge relief to traders who are used to speculate about future price directions. That's it for this session. This we end up with the last episode of basic knowledge on option trading. If this information is helping you, then do like, share and subscribe to our channel and press the bell icon to be notified on every update from XK Advisories. Thank you.